Hello everybody and welcome to this latest video discussion as part of the RICS Tech Partner Programme. My name is Andrew Knight and I sit within the Standards, Regulatory and Thought Leadership part of RICS. My role is to look at the whole impact of data and technology right across the built and natural environment. And with over 130,000 members working globally, right across the property life cycle, looking at rural, land, residential, commercial, alternative assets and infrastructure, data and tech is having a profound effect right across our profession. And I'm really glad today to have Howard Radley join me from Radley Associates. So please do join me, Howard.
Hello, Andrew. Very nice to meet you, and thank you for inviting me to join you and share some ideas with your audience.
Indeed. Well, great to have you on today, Howard. And as ever, before we get into the kind of bits and bytes and the technology and the issues around data, it's always great to have a bit of a kind of a backstory on the human side of things. So it'd be great to have a bit of a background on Radley Associates, you and the team, the skills, experience and stuff. So please do give us a bit of an origin story, as it were, Howard.
Yeah, so we're a firm that really, we're all based around risk management. So that's really where we come from, working with leading banks and other financial institutions to help them measure risk. Most of our clients are typically large pension funds, and that's really where I'm going to focus what we're talking about today. Personally, my background is I have a doctorate in economics from Oxford, and all my colleagues have similar sorts of backgrounds. We founded the firm back in the early 2000s, and as a result of the great financial crisis or crash, we were engaged by a number of institutions, including UK UKAR, Asset Resolution, which essentially was the three government-backed banks that were formed after they had defaulted. What they had was a lot of commercial real estate sitting on their balance sheets that had defaulted, and the government needed a way to work out those loans, and they asked us to help them. From that, we began to develop our approach and the software that we'll talk about a bit later. But really, that has changed the way we start to think about how you do analysis in real estate, and we think we've come up with something that's very different. I suppose you could describe us as a sort of an unknown British technology gem. No one's ever heard of us, but we do work with some very major institutions. I suppose one of the reasons for that is that most of our work is in the US.
Yeah.
And that's because we've had a fairly slow adoption rate, to be honest, in the UK. And I put that down largely to cultural issues within the real estate industry. And also the fact that the US is far more adept at adopting new technologies. Yeah. And to be very honest, they are within the sort of real estate space, they are far more analytically driven than what we find in the UK.
Indeed, indeed. Now, I'm very conscious that, you know, across venture capital and private equity, that there have been significant investments in what we could call CRETech to support valuation. But how has this investment actually improved our understanding of the value of commercial real estate? I mean, have we, to quote Henry Ford, have we just got faster horses?
There is some truth in that. I was at the beginning of this year, I was looking at some review which listed 20 startups, and I think between them they've raised something like $50 to $60 million. So not a lot insubstantial. But when you actually looked at what they were doing, they were basically creating better mousetraps for the same mousetrap. They weren't dealing with the rodent problem, if you see what I mean. So I don't know if you're familiar with, there's a package called Argus, yeah, which really dominates the appraisal market in the US and is fairly large outside the US. I don't want to be rude, but effectively it's a cash flow, you know, an Excel cash flow model with a dedicated real estate front end. All those 20 startups do exactly the same thing. The other observation I would make is that a lot of, particularly in the UK, a lot of executives in real estate are looking for a silver bullet. Do you have blockchain? Do you have AI in your system? Are you using machine learning? And my answer to that is then inappropriate technologies in this space. What people are looking for is transparency and an understanding of how you've arrived at your calculations and how the analysis works. All those techniques are effectively black box. And so no regulator is ever going to accept a machine learning algorithm that says this deal is riskier than that deal, because they'll say, well, show me how you got there. And if you can't show how you got there, it's not really of any use.
No, indeed, and I'm very mindful that there's quite a focus, for better or for worse, on the kind of mark-to-market, single point in time sort of valuation appraisal approach. How does that limit our ability to sort of support assets over that broader kind of fund management, loan underwriting life cycle? Because clearly a point in time is exactly that, and yet these investments obviously have maturity issues around how they're being invested and how the risks and returns need to be managed.
Well, that gets to a very sort of philosophical question in a sense, which is, when you think about it, the valuation is an opinion about the future. And people get confused between the term valuation and price. Price is what I can get today in the market. That's what someone will pay me. But a valuation is a view about what's going to happen in the future. What will interest rates do? What will capital values do? Will my tenants fall out of bed? Will they, how long will a vacancy last if I do lose a tenant? So a point in time valuation is an accumulation of assumptions about the future. And when you start to think about it, there are a lot of assumptions going into a cash flow model, but we get they produce a very accurate result, but it's what I would say is spuriously accurate. It's misleading in its accuracy, because you get down to, and particularly in sort of an Argus model, the expenses related to the doorman's shoes sort of thing. And yes, you'll get down to that last dollar and cent or pound, last pound. But the question then becomes, well, what if I just change interest rates by 1% in that calculation? And that swamps every other change. And yet we know that the Bank of England will tell you they can't forecast interest rates out beyond 3 months and get it right. So what we want to be able to do is say that you can't know the future, but there is something you can know about the future. And that is, how correlated are all these inputs? What is the relationship, say, between interest rates and rental rates? There is a historical relationship. And once we can understand all those relationships, we can start to build something called a distribution. That is, what's the upper bound and the lower bound of values that we might get back? And that gives us huge insight into decisions you make, particularly if you're a fund. How do I to build a fund or a portfolio of assets that gives me the sorts of returns I'm looking for and the sort of risk that I'm prepared to accept?
So, that leads us on to perhaps some broader questions that I'd like to hear your thoughts on, about some fundamentals here about the concept of value, and particularly volatility, because obviously, as the joke goes, never make predictions, especially about the future. So there's that sort of what do we need to sort of almost redefine when we talk about value, and then think about these issues of volatility?
Well, that's a very good point, because volatility is something you can know. we can forecast volatility, and there's a huge amount of evidence to suggest that you can do that. What you can't, as you say, do is forecast the answer. I'd love to have a TARDIS, but I don't have one. However, once you start to understand, there are a couple of things. I will divide risk into 2 types of risk for real estate. There's what you would call the idiosyncratic risk. I'm sorry to use technical terms, but the idiosyncratic risk, which is the risk within that asset. So I've got a building. The beauty of a building is, of course, I've got legal contracts defining my cash flows. So I've got 3 tenants or whatever number of tenants it is. I know how long that lease is going to last. I know what they're going to pay me and what the rules are around how they pay me. I also know what expenses they're going to pay for and I'm going to pay for. So I've got a very defined set of, if you like, idiosyncratic risks. What the great uncertainty is the market. And if you look at real estate historically, the risk is in the market, not in the building. The building will react to the market, and that's what we need to understand. And different buildings will react in different ways. And that's the beauty of real estate, is that you can now begin to construct a portfolio where you can offset the risk in one building with another building. And so you can start to build a portfolio that gives you very defined returns. Now, it's sort of a holy grail of investment strategy. It's what's strange is real estate is an alternative asset. It's not treated that way, yet it is the one that is most amenable to this methodology. If I were to look at equities, for example, well, who knows how well Apple's next product launch will be? That's, it's a matter of opinion. I've got a set of leases. I've got, the British government or a local authority renting my building. Well, I know how likely they are to default. I know roughly what rent I'm going to get. It could be a corporate. Well, if they've got a, if they're AA rated corporate, I've only got a sort of 0.3% probability in the next 12 months that they'll default. So I've got all this lovely data. The question is, how do we use it? And is there a better way of using it than that point in time forecast that doesn't really tell me very much? So I think that's...
Yes, sorry, Howard. I was going to say, so I mean, you've mentioned their equities and obviously the other asset types in the broader capital markets. I mean, what should the valuation and appraisal profession learn from the capital markets and their approach to portfolio management, correlation, diversification, the concepts of risk-adjusted returns, maturity matching? Because, arguably there's a desire to have commercial real estate very much as not just an alternative, but being able to be managed in the same way as these other types. What are these lessons that we should be learning as valuers?
Well, there are a number of things. I mean, one of the key factors that investors look at is what we would call value at risk, which is, what is the tail risk? What's the worst that could happen to me? So if I'm constructing a portfolio, say for a pension fund, or I'm a bank lending money to real estate, what I need to really understand, apart from my average returns, is what happens in extremis, because that's what investors often worry about. Now, measuring tail risk is something you can't do with that point in time valuation, because what do you do? Think about it when you run a cash flow model. You do a high, your expected case, which is the one you hope to get. And then you'll say, well, if it all goes wrong, what's the worst that will happen? And if it all goes right, how good could it be? The problem with that is you have no probability you can assign to those. So you don't know. You could say, well, if Russia continues its invasion of Ukraine and the world all goes terribly pear-shaped, how bad could it be? But how likely is that? So what we're trying to do is understand, what does that tail really look like? And therefore, how much should I, how happy am I investing in those assets? So coming back to your question about what have we learned from other asset classes, if you take a typical insurance company or a pension fund, what they'll do is have a big macroeconomic model that will say, this is our forecast of the probabilities of interest rates, GDP growth rates, whatever it is, going out for the next, say, 10 years. They'll run their liability model, their pension requirements, through that, and it will say, well, this is the variation, high and low, of what I need to pay those pensions. And I can now use a bond portfolio and match it against that. I can say, well, I can construct a bond portfolio that meets that. I can construct an equity portfolio that meets that, because we have huge amounts of data. Up until now, real estate has been left on the side because it can't do that. What we're trying to do is say, give me your macroeconomic model and we'll use that to drive our cash flow models. And then we can match your liabilities to the assets in your portfolio. So we can match, as you say, the maturity profile and the risk profile. So let's say you want to be able to guarantee an 8% IRR for the next 5 years to pay out your pensions. I'm happy to accept, it dropping to 6%, and it'd be great if it went to 10%. But what's the probability it will go to 4%? That's what I need to know. So that's really what we're doing.
So does that lead inexorably almost to the sense that the valuers and appraisers should be thinking not just about the absolute value, that kind of mark to market now, but more about probabilities and the shape of that distribution of value over time, and dare I say, getting into the statistics of thinking about what does that distribution look like in terms of skew and kurtosis, to use all these technical phrases, and standard deviations? Is that where you see valuers moving into that more well-rounded view?
There's a number of things. Okay, so it really depends on use case. So, if you're doing an appraisal for a bank, for example, or that wants to lend money to a real estate investment, what you want to know is how likely are they to be able to cover their interest payments? What's the probability they'll fail to do that? And what's the likelihood that when we come to sell the building at term, or we want to refinance, or if we want to refinance that loan in, say, 5 years' time, how likely is it that that building will be above or below that hurdle? That's far more useful to the bank than saying the building's worth X today. Because saying the building's worth X today only tells them the price I can achieve in the market today, not in 5 years' time. And by the way, RICS' own data says there's a 15% standard deviation between the appraised value and the market, the price actually achieved in the market when they come to sell the building. So you could start off, if let's say you've got a very high LTV loan, and you could have done the valuation, the loan could be underwater day one, and yet the valuation wouldn't say so. So valuers need to think about that risk. How bad could it be? How good could it be? Well, how good could be is nice to have, but how bad could it be is the one we should be worrying about. When it comes to thinking about doing other type, and we could use this technique for appraisals, just sort of standard appraisals, it would require a change in mindset, because instead of giving a single valuation, which is what everybody wants in the market, what you could do theoretically is put a risk rating on that and say, it's worth 100 million with a risk rating of X or whatever it is. Now, we haven't developed that methodology, but there is a lot of evidence to suggest you could do that. And that's something I think an industry body such as RICS would have to get involved in. We couldn't do it as a private company because that would be our opinion rather than an industry-wide. But I do think there is a future question to be asked is, should we be looking at individual, point-in-time appraisals, which we know technically are wrong, or using something a bit more sophisticated, but then that would require another way of thinking about how you do these things. And the market would have to change in attitude.
So I suppose perhaps to use a slightly sort of, humorous analogy, is it almost developing the language of weather forecasters, where we start talking about the percentage likelihood of rain or sunny intervals or snow, and being realistic that nothing is ever, well, perhaps it's 100% as it happens outside your window, but there is that sort of sense of predicting further ahead with models and saying, well, these are now the probabilities of these particular events. And as you say, being clear about the fact that actually the tail risk of a certain probability is going to be very low, but it's still there.
Well, you and I are both old enough to remember when the weather forecast would be on the night before, and you would say, well, it's probably wrong. Weather forecasting 20 years ago was really bad. They didn't really get very far, and it was hit and miss. What's happened in the last 20 years is weather forecasts actually got rather accurate. I mean, I will look at tomorrow's forecast and decide whether I need to take an umbrella with me or not, and it's usually right. So we've gone, what's happened? What's happened is they're using simulation. And they're using a technique actually that what I'm talking about here is exactly the same methodology. Understand historical correlations and use those to drive your model forward. And that's all we're doing. And then it says to you, they won't say it will rain tomorrow. They'll say there's a 10% probability it will rain tomorrow, or there's an 80% probability it will rain tomorrow. So you might say to yourself, well, it may not rain at an 80% probability, but I'm going to damn well take an umbrella with me.
Yeah.
And the odds are that 80% of the time it will rain on that day. So that's what's really changed. And I think that's the mindset we need to move to with forecasting. Now, again, it depends on the use case. If you're buying a building to occupy yourself, you probably don't need to worry about these things. If you are building a pension fund or just an investment fund, then I think you owe it to your customers to understand the volatility. And that, I fear, is where we're not at.
Indeed, indeed.
I think there's a huge amount of cultural desire to say, trust me, I'm a real estate expert, I know the value of this building, rather than we've done some decent analytics that have understood the market risk to this asset.
Indeed. Now, I know you've obviously developed this PROMS platform and approach to these things. It'd be great to perhaps have you walk me through that kind of PROMS solution, and also perhaps touch on the data sources, the technology. As you said, that there's no technological, silver bullet here. It's about using the right technologies for the right kind of approach. It'd be great perhaps to take me through your presentation and tell us how PROMS works and what it does, Howard.
Okay, let me share my screen with you. Yeah. So I sort of thought I'd start off. Sorry, it's a very busy slide, but let's start off by saying, look, what do we people do today? And again, I'm focusing very much on the institutional investment market or the lending market. So what you're looking at here, if you like, from the left side to the right side, is the process either a bank will go through when it wants to lend money, or an investor will go through. The first thing is at the top, there's a huge amount of really good quality market data. Going back 50, 60 years, you've got things like MSCI, or what used to be IPD, collecting lots of data on rents, vacancy periods, capital values. You've got lots of data from the US Fed, Moody's captures. There's just a huge amount of data. When you think about it, it's not actually used. It's used anecdotally today. So people will say, well, in my opinion, I looked at the data and it told me this, but it's not incorporated into the analysis. At the other end of the sort of, if you like, data question is the data about the asset itself. So what I'm showing here in this sort of this blocked off arrow chart is nothing is consistent. So people will start off, someone will say, here's a loan proposal, or here is a property you might want to buy, and you'll get a PDF sheet. And on the PDF sheet will be some high-level numbers. And so what people will do is they'll enter it into Excel or something to do a quick and dirty analysis. Then they say, well, let's go and buy it, and then they'll go into the underwriting. Well, the underwriting will be maybe done in something like Argus, where they'll at least do the part of the analysis. They can't add the debt in because Argus doesn't have a debt function, but then they'll do some of the underwriting there. Then someone will say, we know what, we need to restructure this deal before we do it. Well, the only tool we've got to do that in is Excel. So you can see the data's getting bounced around from system to system. Every time we go into one of these big organizations, they say, our big problem is that we have no consistent data. So everything's all over the place. When you get to portfolio management, it now goes into a completely different system. So now we own the building or the loan. It's going to go into some big operational accounting system like a Yardi or an Intuit MRI system, or whatever, or a loan servicer. So you can see, and then someone will say in the pension fund, but what we need to do is decide how much capital to allocate to the CRE unit. Well, we haven't got any data to do that with, so we'll go back to Excel. So you can see it's a very, very fragmented process. There is no consistent view of the asset through its life cycle, and that causes huge problems. What we propose, and what we do, is we do that all in one system. So the two things that we're doing is we're bringing in the market data into all the analysis and actually using the market data. And I'll come to that in a moment. And the other thing is it's one system from deal evaluation through to capital management. So you have one source of the truth about the asset, and that's really important. And basically people need a motivation to keep a single model of the asset, because it's all too easy for organizations to say, well, I've finished doing my underwriting, I don't need to look at this again. But if you have the analysis always done in the same system, you have a reason to keep it updated. So what we're doing, and I'm sorry, this is another busy chart of mine.
That's all right.
But this is, if you like, the underlying methodology. This is how the system works.
Right.
So on the left side, what we're doing is we're taking in all that historical data that I talked about, the Bank of England, the US Fed, Bank of International Settlements, huge tons of data that we're using. And what we've done is we've built this massive macroeconomic model. And this is a very standard process. This is how the Bank of England does its interest rates forecasting. But we're lucky because we're limiting ourselves to a very narrow field. So it makes it a bit easier for us. So we've got all this data on what does the economy do in good times and bad times. And bear in mind, we've got 4, possibly 5 major crises in that data going back to the mid-1960s. The oil crisis, In the UK, we had the big real estate crisis with the what they call the lifeboat, when they had to rescue a number of property funds, etc. So we've got that data, and then we correlate that. And what we mean is we see how rents, capital values, vacancy periods, tenant defaults, and those sorts of things have moved with that economic data. So now we come to the middle bit, which is a cash flow model. Cash flow model, just like everybody else's cash flow model. You're saying, here's all my income, here's all my costs, etc. What am I going to get at the end of the day with a discounted cash flow? But instead of running that cash flow once with a whole bunch of assumptions about what everything's going to happen, we're taking those correlated inputs to drive a simulation. So we in fact run the cash flow, as you can see in the middle of the chart, is cycling through. So the colored bands are the rent from in this case 5 different units. The black line that you can see flopping up and down, the debt against that, so that's a floating rate loan against it. And so what you can see is every now and then you get a dip where the black line pops above the colored bars. That's where, then this is for a loan, where the loan will have defaulted. Now, it's only in this case, it's only cycling through 100 times, but we actually do it 10,000 times. That's just for illustrative purposes. So we're taking in all the property and loan data into the cash flow model. Any assumptions you'd make, well, we're going to knock down the left wing, the west wing and rebuild it, and that's going to cost us X amount. You can put all that in. All those assumptions can be built in. But what it gives you at the end is a distribution of answers, and that's the key. It's not giving me a single answer. It's giving me 10,000 answers. So that's the reason we'd run it 10. Well, we could run it 100,000 times. The reason we run it 10,000 times is to pick up that tail risk. So the number of times things go really badly wrong. Now, the other beauty of this is, if I do this, if I've got a portfolio of assets, I can now stack these all up in the same way and run them all through the same system. And I can start to see which of my assets are highly correlated with other ones and which ones are highly diversified. So I can start to smooth out the income that I'm going to get, as I said, for a pension fund, or if I'm a bank, to make sure that as a portfolio, my maximum loss will be reduced. Something classic the Bank of England has been really trying to get banks to do for a long time and had a lot of difficulty with. But it allows me then to measure it at the portfolio level. So another way of looking at it, so this is a simpler version of that chart, which is on the left side, I've got all my sort of macroeconomic factors. I've got interest rates, GDP growth rates. And what I'm trying to understand is, how do those affect my rents, my tenant default rates, how long a vacancy will last, what sort of interest I'm going to get, interest payments I'm going to pay on a loan, what's going to happen to capital values, etc., etc. And that then allows me to drive my income distribution, my capital value distribution, which gives me my total returns. That could be expressed either as an IRR or just a valuation. So essentially what we're doing is this sort of, I'm trying to understand the 2 types of risks that affect real estate. One is, and the key one in our view, is market volatility. We know rents go up and down. We know that unemployment and therefore occupancies go up and down. We know that the capital values change, etc. But we also want to understand how that affects this building. I can have 2 identical buildings next door to each other in the same market, same everything, but one's got 50 tenants in it that are all rated, say, BB, with a variety of lease endings, and I've got another building with a single B rated tenant, one tenant. Well, intuitively, I know that the single tenanted building is more risky than the other one, but by how much? What is the value of having that 50 tenants instead of 1 tenant, etc. So there is idiosyncratic risk or differences that are worth knowing. So it's not just about market volatility, it's about how that market affects my asset. Sort of output you get, and this is where it really gets interesting. So again, I need to sort of explain a little bit. What you're looking at here these are distributions. People are not used to looking at these. So if you look at the left-hand chart, that's my income chart. And what you can, if you imagine the sort of dark blue line running down the center as your, if you like, expected case over time. So that's my income over time. What you'll see is probably on average, you go down right down the middle and you just get a flat, rather boring sort of flat line going across top. But what you can see is those triangular dips down, and those are the probability distributions. So each one of those dips represents a lease event in this case. And it could be the lease comes to an end or whatever it is, but let's assume it's the lease coming to an end. Well, we know there's a lot of data on this that sometimes tenants decide not to renew on you. Then you've got, how long is my tenancy? How long is my vacancy going to last? How much can I have to pay to upgrade the unit in order to get the next tenant? Now, if you use a traditional cash flow model, all you can say is, I've got an 80% probability of keeping my tenant. It doesn't tell me anything because it's a binary event. I either have a tenant or I don't have a tenant. So by averaging everything, you end up with a mush. It doesn't tell you anything. Whereas this way, because each scenario is an individual, if you like, view of the future, and it's binary. There is a tenant there paying rent, or there isn't. That's it. Now you can start to come to your averages, and that's why we get these very non-normal distributions. This is not an average. It's not all sort of smooth. You can see it's all lumpy. That's sort of telling you that there's a lot of analysis going on underneath it. And then on the second chart is really saying, over time, the asset value becomes less and less certain because we just don't know the future. So I've tried to give you an illustration here of 3 assets.
Okay.
How along the top, on average, if you ran them through a standard cash flow model, you'd get roughly the same IRR. However, the risk to each one is very, very different. And therefore, the true income that you will get from them is likely to be very different. Now, intuitively, people will know this, but they won't be able to measure it. So if you take the left-hand one, classic sort of what I would call a trophy asset. It's way over rented. You know, the market is overvaluing it because everybody wants to buy it. However, it's got a single tenant. Now, it's quite a well-rated tenant, but it's a single tenant, and it's in a trophy asset. So first point about a trophy asset is it's overvalued because everybody wants to buy it. So it's going to be above, if you like, its natural, what the Americans would call cap rate value. So there, in that case, all the risk is on the downside. There is no upside potential. You're not going to rent it for any more money. It's already over-rented. And if you lose the tenant, unlikely though that is, it's possible, you're going to be in trouble. Second building, one in the middle, is a sort of more, if you like, plain vanilla office block. And yes, it's got a single tenant in it, but the tenant is not paying above market rent. The market rent is the dotted line that runs across the top.
I see, yeah.
And that's just the average. What we're trying to do here, just is more for illustrative purpose, we're showing the average market rent, and we're showing a single, the top one is a single cash flow. But what you can see there is it's a lower rated tenant, so you're more likely to lose that tenant. However, because it's not an over-rented building, you may get lucky and rents may rise in that area when you lose a tenant. So actually there's upside of losing the tenant, or potentially upside of losing the tenant. So on average, it's fairly close to its forecast, but it is a bit below. It's more volatile than you might think it was. The right-hand one is the dog. That's the Cleveland Industrial Park. It's half empty, you know, it's partly empty. You can see it's not fully rented out. It's got lots of low-grade tenants in it. You know, small SME businesses. But it's certainly not over-rented by any means. It's under-rented. So in effect, all you're less, you know, because you've got this churn of large numbers of tenants, you might lose 1 or 2 here and there, but you're not going to lose them all in one day. So your probability is that you're going to be able to maintain that level of income, but actually there's some nice upside. If you can upgrade this place, you're going to get something better. So you start off with a cash flow model that gives you roughly, if you run it as a single cash flow, you get roughly the same answer. If you run it as a distribution, you get very, very different answers. Another, and if I may show you another chart.
Yeah, surely.
Okay, so this is a what we call a cumulative distribution. So if you look in the middle of the chart where that average DCF value is pointing at, that is at the 50th percentile. That's your return at the sort of average level.
Yeah.
That's the middle scenario, if you like, and that's its valuation at that point. On the left side is the worst case scenarios. That's your one in 10,000 chance. So the very last one at the end is 1 in 10,000. It's very unlikely. 1 in 10,000 is a very unlikely event. And on the right side, where it shoots up a bit, that's your very, very unlikely uppercase. So that sort of gives you a sort of sense of how good and how bad it could be. What's interesting is, say, for example, if that building was currently on the market at, say, 102 million, it would be overvalued. Mm. If it was in my portfolio and someone had offered me 102 million for it, I might well accept that offer, because by my calculation, they are valuing it more than I think it's worth. What's really interesting to the investment market is that tail risk, which is, how do I make sure that if I've got that tail risk, can I buy another asset that offsets that risk?
Yeah.
It doesn't fall over when this one falls over. And that's really what I'm trying to create with a balanced portfolio. So now, same chart, but now at the portfolio level. So now I'm looking at an entire portfolio, and what I'm looking at now is, what are my average returns? And this is really useful for investment management, or as we were talking about before, matching your assets to your liabilities. So this is how you do it, really. Another chart that I think is sort of interesting. Okay, so what we've done here is we plotted a very large portfolio. This was, as I remember, about a $50 billion portfolio. So huge global portfolio of assets for one of the big insurance companies. And each pink dot represents a building. Mm-hmm. And the big blue blob represents the portfolio average returns. So what you can see, and that line that we've drawn represents what we would call the risk neutral line. So on the left side, it's what you would get, the return you'd get from a US government treasury, i.e. no risk, very low return. And on the right-hand side, we chose the S&P 500. Average returns over 5 years. So, it gives you a sense of the risk. Anything below the line, you could argue, is value destroying in comparison to a risk neutral line. Anything above the line is accretive. So what the first thing you'll see is that the blue blob is slightly higher on average than the total average of all the assets in the portfolio. And the reason for that is you get this sort of portfolio effect of, because you're actually creating value out of getting rid of some of the risk by having that diversification. The other thing that you can do is you can now start to remove assets from a portfolio that are below the line, so that are destroying value in your portfolio. So you can now start to build and redesign portfolios for those risk-adjusted returns. And by the way, I challenge you, or not you personally, but I challenge the audience to go on to any pension or investment website that is invested in commercial real estate, and I guarantee you, almost certainly, they will talk about superior risk-adjusted returns. I would challenge them to explain to you how they've measured risk.
Yeah. You
cannot adjust for risk if you haven't measured it. And since the majority of them do not measure risk, I don't know how they can make that statement. So that's me being a bit pokey. Okay, I won't go. This was just some work we did with the Ontario State Pension Fund. Just sort of an example of what you can do with it. We were trying to work out for them. They were invested in, sorry, this is published data, so I can't show it. And by the way, I can't name most of our clients.
No, I understand.
For obvious reasons. But the proof of the fact that this does work is that we have some very, very large, I think we're managing something like 150 billion of real estate assets on our systems. So it has been adopted. what this is showing you here, and it's really quite interesting. So if you start off with, again, we put that risk neutral line. I'm sorry, it sort of comes at a bit of an odd angle on this one because of the chart. But if you look at that risk neutral line, we start off with their Canadian, what they want to understand was the impact of, should they have assets in the US as well as Canada? Is there an advantage to that? Or is the FX risk, does it sort of wipe out your advantage? So here we start off with a Canadian portfolio with about a, what is it, a 9.75% return, with about 6.2% volatility. So that's your starting point.
Yeah.
The fact is that's measuring each asset individually. So that's just the weighted average returns. Now we add in the diversification impact of having all those assets in a portfolio. As I said, we can run the portfolio where we take each asset out and then put it back in to see what it does to the portfolio. And what we can see is two things happen. One is our risk drops because we've got this diversification effect from just over 6% to about 4.75%.
Yeah.
So we've got an immediate advantage. You'll also notice that it goes up in value slightly. You improve the returns slightly.
Yeah.
Complicated technical reasons why that happens. I won't go into it now. The next thing is we add in a US portfolio in US dollars. So now we've got currency risk, obviously. So what we've done is we've popped up our returns. They've gone up now because we've got this better returning US portfolio as it happens. But our risk has gone up slightly. And then we add in the FX risk and that goes up slightly.
Mm-hmm.
But now we measure the impact of the diversification of having US assets with Canadian assets. And the beauty is when bad things happen in Canada doesn't necessarily mean bad things happen in America. So, and we're measuring that. And so now our risk has dropped back down again to below the total portfolio risk. So you can see the advantage there of having a cross-border portfolio.
Indeed, yeah, and I suppose it's a great indicator of understanding the nature of each decision you make. You know, the graphically there you can see very clearly the pros and cons, to use the sort of layman's term, of each of those individual decisions.
So the net is that our system is very applicable to large investors, banks. I think there is huge application in the appraisal market, but I don't think the market's ready for it. And we haven't even attempted to sell to them, largely because we feel that there's a big educational issue to get people to understand the maths behind what we're doing. It isn't that complicated, actually, but it is things that people are not familiar. People are not familiar with thinking in terms of risk and probabilities. They like give me the number, give me the answer. And I think culturally we need to get away from that because that's not how the world works.
Indeed. Well, Howard, it's been absolutely fascinating, and as you say, I think hopefully this might be the beginning of that kind of educational process to start thinking about value in a different way, because in previous roles here at RICS, I've done a lot of work with the capital markets, and as ever, the desire has always been to have commercial real estate as an asset type that's understood and managed in the same way as other asset classes. And I guess we're still not there, are we, in many ways? But we need this same kind of thinking, and we still need to leverage, as you say, the power of these correlations and diversifications, which are so well used and understood in the bond and equity markets. And we need to get the same data and same technology and same thinking with commercial real estate. But for today, thanks ever so much. It's been incredibly informative and very interesting. And I look forward to catching up with you again in the future.
Really appreciate it. Thank you ever so much, Andrew.